Well, thanks a lot for having me today. I have to say, it's quite an honor to get to speak at the Oregon Wine Symposium. I think I can speak for my wife and I when I say that we're both massive fans of Oregon wine. We've probably had more of it this year than any other year in our lives. It's a little embarrassed to admit that, but 2020 was that kind of year. So my home state of Virginia, we also pride ourselves in producing a whole lot of wine. I think we have something like the fifth largest wine grape production in the country. And please don't tell anyone in Virginia that I said this, but the wine in Virginia isn't quite of the same quality as Oregon wine. Although the Shenandoah Valley has many beautiful wineries and we do enjoy it a lot. So anyway, long story short, thank you for having me. My name is Chris Constantinos. I am the Chief Investment Strategist and also the co-chair of the investment committee at a firm called Riverfront Investment Group, which I was one of the founding members of back in 2008. It was a strange time to start a company. Much like today, the nation was embroiled in a crisis that affected just about every sector of the economy. And what we found is that sometimes great innovation comes out of desperate times. And I think that's one of the things we're learning in our current era as well. But I'm proud to say my company's been around for 12 years, going on 13. And what does my title mean? Well, as chief investment strategist, my job is essentially to try and synthesize economic data, a whole lot of it, as well as other data, both qualitative and quantitative, including views on politics and the intersection between politics and economics, to try to get a sense for what stock markets in the U.S. and abroad might do in the year ahead, in the future. And a lot of what I'm going to say in the first part of this presentation, you can actually find in Riverfront's 2021 Outlook. I'm going to upload a summary of our Outlook for anyone on this webinar that wants to download it. Hopefully you find it useful. There's also a lot of really good research on our website. My company's website is www.riverfront, I as in investment and G as in group. So riverfrontig.com. You can download a lot of research. We produce research weekly and make that available free of charge for anyone who wants to read it. And so for the purposes of today, I thought we'd spend a few minutes at the outset talking about what my bread and butter is, which is trying to predict stock markets. But then also for the latter half of our conversation, I wanted to try to look at some data that I thought was particularly germane to the wine industry. And this would include data such as consumer spending, small and medium-sized business optimism and propensity to hire, some employment trends, particularly in hospitality, and some mobility trends. And I even tried to tailor it a little bit to your state, because I'm sure many of you that are attending this webinar are small business owners in the wine industry in Oregon. And I tried to provide some sort of some context for what's going on there to the best of my knowledge. So let me jump into it. First things first, our outlook for the U.S. economy and particularly for the stock market is still constructive as it was last year for 2021. And I'm going to give you a couple of reasons why. The economic dislocation that we saw starting in March of 2020, which of course was related to the pandemic shutdown, is unlike anything I've ever seen in the 2 decades that I've been doing this professionally. And in fact, if you go back even further, you'll see that the rapidity with which unemployment spiked to levels that none of us have seen in the U.S. modern finance era was just breathtaking and completely devastating for our economy. Because of that, the reaction by policymakers, both on the monetary side and the fiscal side, was also equally as dramatic and unprecedented. And one of the charts that we show in our 2021 Outlook that is kind of a gobsmacking chart if you look at it relative to history is we track aggregate money supply in the U.S. economy. And actually, we don't just do this for the U.S. We also do this in other major economic regions of the world, such as the Eurozone, Japan, and China. And what you'll see is that aggregate money supply, as economists define it, M2, it's been changing. In fact, it's been growing in the United States at over 20% year over year. This is truly unprecedented from anything we've seen post-World War II. And what this suggests to me is that there's a tremendous amount of capital sloshing around the system. And what we believe at Riverfront is that when you have that much capital in the system, eventually it ends up finding its way into real assets, things like real estate, for instance, and also eventually into financial assets such as stocks. On top of the massive amount of capital that's currently sloshing around in our financial system, there's also something really interesting happening below the surface in the economy. Now, we'll get to the unemployment in a bit, but I want to talk to you a little bit about U.S. corporate profit and net cash flow. We get this data from the Bureau of Labor Statistics, and this data isn't just about the S&P 500 companies, the publicly traded companies. This is actually a broader swath of the U.S. corporate sector, including both public and private companies. And what this data suggests is that indeed, in the first part of 2020, both U.S. corporate profit and net cash flow plummeted. But what's fascinating is that in the latter half of the year, it actually rebounded, and in fact, rebounded to a new all-time high, both for net cash flow and corporate profit. This is somewhat mind-boggling if you think about the economic dislocation that we're currently experiencing. Technically, our country is still in recession, although all indications are is that we're going to be exiting that relatively shortly. But nonetheless, think about that for a second. Record high in U.S. corporate profit and net cash flow. Well, I can give you some perspective just from our little company here in Virginia. We employ roughly 50 people. We're definitely what you would call a small enterprise. And what we found is while we missed our revenue projections, given some of the volatility in the market, we were able to make that up because we cut out a lot of our expenses as it related to travel and entertainment. And I suspect, writ large, this is the same kind of story that's playing out all across corporate America. That during the pandemic, corporations are flexible and they learned how to make do with what they had. They learned how to communicate in different ways, and they, in many cases, reduced their expenses in some cases dramatically. And so, when you think about corporate America, to us, the data that we're seeing is corporate America is still pretty flush. And that is generally speaking, a good sign for the economy and particularly a good sign for the stock market. Now, while I'm talking about the stock market, I'd be remiss if I didn't address valuation. If you turn on the news today, you're seeing a tremendous amount of speculation and chatter around just how expensive the stock market is, particularly since we're now 11 plus years into one of the most powerful structural bull markets in history. And this is a very, very valid question. I do think that there are certain valuations in certain industries or sectors or certain asset classes that appear to me like they're highly elevated. And in fact, if you just look at the stock market writ large relative to its own history, by almost any valuation metric that we track, it's indeed true to say that stocks relative to their own history appear to be quite expensive. However, and this is a really, I think, important point, if you compare stocks to their asset alternatives, to the risk-free alternative, if you compare stocks to, let's say, U.S. Treasury yields or bond yields, what you'll find is that relative to their own history, relative to bonds, stocks actually appear reasonably valued. We have a pretty illustrative chart, I think, in our Outlook summary that you can look up that illustrates this. And what we did is we took what's called a price to earnings ratio on the stock market, and we used the inverse of that to get what's called an earnings yield. We also compared the average dividend yield on the S&P 500. We compared that to the U.S. 10-year Treasury. And again, we don't think you should look at stocks in a vacuum, but rather look at them relative to the risk-free alternative. And what you'll see is, unlike the late 1990s, or even unlike the mid 2000s, which were two prior periods of what you call bubble-like stock markets, earnings and dividend yields are still significantly above bond yields in this country, which suggests to us that relative to bonds, stocks still offer reasonable value. What's even more interesting is if you look outside the United States, that valuation discrepancy becomes even more pronounced. Another way to say that is that international stocks appear, from a long-term perspective, more cheap than the U.S. And that may portend good things for international stocks over the next 5 to 10 years. The last point I want to make on our market forecast is to talk a little bit about the U.S. dollar. And this may be somewhat germane to some of you watching this webinar because you may be in the wine importing business or exporting business. And so therefore, foreign currency fluctuation hopefully is relevant to you. So I'll give you some views that Riverfront has on the U.S. dollar currently. For a few years now, we viewed the U.S. dollar as being structurally overvalued and just waiting for a catalyst to stop the almost interrupted, more than decade-long bull market that the U.S. dollar seen. And what we've noticed, tracking the trend of U.S. dollars versus the trade-weighted currency basket, big currencies such as the euro, the British pound, and the Japanese yen, is that we believe that the U.S. dollar has now peaked and is entering a new structural downtrend. What does this mean? Well, for the stock market, surprisingly enough, maybe to some, this isn't necessarily a bad thing for U.S. companies. Large cap, publicly traded U.S. companies tend to be export oriented, and therefore a weak dollar may actually benefit their competitiveness overseas. If you're a U.S. investor that's looking at international stocks, though, this can also be beneficial to you if the dollar continues to weaken, because if you're investing in an unhedged fashion in international assets, this means that the upward movement of those foreign currencies relative to the dollar can also be a benefit to your to the return in the assets you're buying. So we believe the U.S. dollar is going to be quite constrained in terms of upside from here, and may even continue to weaken some in the next few years. We view this not as a bad thing, but rather a good thing for global stock markets. Now, of course, if I'm giving a market forecast, I would be foolish if I didn't also tell you what I saw as the potential risks out there, right? Even for a group like Riverfront, which currently is constructive on stock markets, we have to constantly play devil's advocate with ourselves. We have to constantly figure out which ways maybe we'll be wrong. How will we know? So there are some things that keep us up at night. There's certainly, risks that you have to be aware of on the horizon. The first one, and this should be obvious to anyone on this webinar, is COVID-19. COVID-19 is unlike anything we've ever seen before. You have to go all the way back, practically a century, to the last global pandemic that was as widespread as COVID. Certainly, we've had issues like MERS and SARS, Ebola, some of these other things. But in terms of widespread impact to the entire globe, and particularly for the United States, COVID is certainly in a league of its own. And we don't know how the virus may mutate. We're just now in the early stages of the vaccine rollout. And so, we still have, there's still a lot of uncertainties out there. One point I'd like to make, though, and this is just, we have a slide in our Outlook that talks about ingenuity over infection. What's amazing to me is that the genomic sequence of COVID-19 was decoded by scientists in something like 69 days, which is by several orders of magnitude quicker than any other pandemic in history. And so, I believe that necessity is a mother of invention. I think humans are very resourceful when their backs are up against the wall. And so I continue to think that we will beat COVID-19, or at least get it seriously under control. The other thing I note is that the vaccine efficacy from numerous different vaccines has been, frankly, better than many people expected. The other offset to this that I'd mention is that policymakers, as they have before, will most likely step into the breach once again should COVID-19 continue to be a problem, as it is at the time of the recording of this, which is in mid-January of 2021. Some other risks out there, of course, is I get a lot of questions about runaway inflation. Might runaway inflation cause the Federal Reserve to tighten, to raise interest rates, and therefore would that be a major impediment to the stock market? Our counterpoint here is that technological gains, excess supply in certain industries, and lack of pervasive wage pressure suggest to us that inflation should not be a major issue in 2021. We also believe that the Federal Reserve is likely tolerant of some inflation, given some of their recent statements. I'm going to come back in a couple minutes to that point about wage pressure, because I think this is certainly germane for the hospitality industry. So that's our market forecast. And I promised you in the second half of our time together that I try to put together some data that I thought might be of use to folks in Oregon, folks who are in the hospitality industry, the restaurant industry, the wine industry. So first of all, I mentioned COVID. You certainly can't do any kind of call on anything these days and not mention COVID. It is the 8,000-pound gorilla in the room. The bad news is right now, the COVID update is not good. I'm recording this in mid-January, And as of the most recent data that we've gotten from Johns Hopkins, new cases have recently hit an all-time high in terms of confirmed cases in the U.S. This is also, by the way, this is also being mirrored globally. So if you look at global cases, same kind of story. Unfortunately, deaths have also hit an all-time high. If there was one tiny ray of hope or sunlight in this otherwise currently bleak data download of the COVID situation, it is that we are seeing that fewer cases as a percentage of overall cases need to be hospitalized. And those that are hospitalized, the severity of the hospitalizations appears to be dropping. And again, going back to what I said earlier, necessity being the mother of invention, humankind has learned a lot in the last 9 months in terms of what to do and what not to do when treating COVID-19. And we are seeing that in improved mortality statistics per infection. Again, I'm not trying to sugarcoat what is otherwise a very bleak situation, but there is some rays of hope in the data that we're seeing. Now, how is COVID manifesting itself in the restaurant industry? Well, we track data from a network called the Open Table Network. We look at a year-over-year change in reservations and walk-ins of seated diners, and this is data that goes all the way. This is data that goes all the way across the United States. And unfortunately, with the resurgence that we've seen since Thanksgiving and COVID, what we've also seen is that the year-over-year change in reservations is also down about 50%. At one point, this had really, had improved at the end of the summer and the beginning of the fall. These numbers had improved a lot, but now we appear close to lows, unfortunately. And of course, I'm sure for those of you operating wineries, whether that's in the state of Oregon or elsewhere, this is obviously affecting your ability to do that. And also, I'm aware of some shutdown of hospitality within Oregon itself. So, of course, less traffic means less spending. And I have some data on this as well. And I was actually able to get this not only for the, across the United States, but also in Oregon. And I want to give you a resource that I find really useful in tracking this kind of stuff for any data nerds out there that want to check this out. There's a great website called tracktherecovery.org. It's completely free. It's a joint venture between Harvard University and Brown. And what it does is it looks at spending and employment by income quartiles and also by geography. And so I was able to pull some pretty interesting data on your home state of Oregon. Essentially, right now, total spending in Oregon is down. And I'm sorry, I should say this is across all types of consumer spending. Year over year, consumer spending is down about 6.4% in the state of Oregon. However, if you look at just restaurants and hotels, that number is off almost 44%. So clearly that lack of traffic that we're seeing is impacting both nationwide and in your home state restaurant spending. And this, I think, is probably a good segue into part of the state of our new economy that I want to spend a little bit of time talking about, because I think it's really important. We have what's called a dual speed economy here in this country. And by the way, this was a pre-COVID phenomenon. This has been happening for quite some time. And it's linked to a number of other phenomena, not least of which is income inequality, which has been growing in the United States for quite some time as well. But what I mean by a dual speed economy is that if you bifurcate workers into the more educated, what I would call the knowledge worker space relative to the rest, what you're seeing is you're really seeing two different economies in America. Knowledge workers, first of all, tend to be higher earners, but as it relates to COVID, the other thing is that knowledge workers also tend to be much more likely to be able to work from home. There's been some very interesting studies done. The Bureau of Labor Statistics actually put out a paper, I believe it was in the beginning of this year, on this very topic. And they basically said that this knowledge work, this classification knowledge worker, represents roughly 40% of the workforce. However, it also represents over 45% of American wages. And if I could make some very huge generalizations here, the knowledge workers tend to be upwardly mobile. and they're much less likely to have their work disrupted by COVID. So if I mentioned that's roughly 40% of the workforce are folks that were able to keep working through COVID and maybe didn't even see that much disruption in their career or in their earnings power. This group of people, if anything, probably has a lot of pent up consumer spending demand. And the reason I say that is because restaurant traffic's down, because air traffic is down. People aren't taking vacations, they're not flying. There's probably a lot of consumer spending that's happening at this higher earners level that isn't currently happening and is representing pent up demand for when we start to get widespread distribution of the vaccine. This could actually be, and I'm guessing maybe second half of 2021, could represent a significant bump in consumer spending for this, roughly half of the economy that fits in this category. And you all know your business much better than I do, so I'm not sure exactly how this trickles down into vineyard visits or bulk wine shipments. But nonetheless, what's fascinating about this, if you look at employment, is how this really differs, high wage earners versus low wage earners, what the employment situation looks like. So it's fair to say that the recession is basically over for high wage earners. If you look at their unemployment rates or their employment rates, actually employment amongst these high wage earners is up 1.2% year over year. However, if you look at the lower wage employment, it's actually still down 19%. And so the big takeaway here is that high-end consumers have money to spend. In fact, as much, if not more money as they had pre-COVID, and there's probably some major pent-up demand. But for that part of your business that caters to the lower end, you should understand that these consumers are seriously struggling, and in many cases are highly dependent on things like the CARES Act, on fiscal stimulus to be able to meet basic needs. And so I'll leave it up to you to interpret how that may affect your wine business and what to take away from that. But it is really important that all of us get a deeper understanding of what this dual speed economy means. And of course, there's ramifications for this that go well beyond any sort of economic or market ramification. These are things that we all as a society need to think about as it relates to income inequality and some of the societal pressures that this dual speed economy may be placing on the U.S. in our discourse. While I'm talking about this dual speed economy, I also want to give you a little bit more statistics on Oregon just to back up what I was saying before. If you look at consumer spending in Oregon, I mentioned overall year over year, it's down about 6.4%. But what's also really interesting is that, again, if you look at those high income earners, consumer spending is actually down about 5.5%. But if you look at low income earners, the consumer spending year over year is actually higher. So their job situation is worse on the low end, unemployment's higher, but their spending is actually up, which is, clearly not a beneficial situation to be in and potentially detrimental for consumer spending in this segment going forward. And just the opposite on the higher end, which again, I think points to this idea of potential pent-up high-end consumer demand that may manifest itself post-vaccine. So we talked a lot about consumer spending and employment, but now I'd like to talk a little bit about small business optimism and some of the trends that we're seeing here. So what's pretty fascinating is starting at about the summer of 2020, we started to see small and medium-sized business optimism improve dramatically from what was clearly recessionary levels earlier in the year. Where do we stand? Well, I have data as of December of 2020, and we actually saw this small business optimism take a hit recently in the month of December. It's still pretty elevated relative to history. It's not in what I would necessarily term as a danger zone yet. However, it appears that small and medium-sized business owners are unsure about their business going forward, more so than they were in prior months. And we think this not only has to do with the lingering uncertainties around COVID, but it may also have to do with some uncertainties around tax implications of the new U.S. political regime. So the big takeaway here is that small and medium-sized business owners, when they're unsure, they're usually less likely to invest back in their business. They're likely to keep more capital on hand for a rainy day. However, there's also potentially a silver lining for business owners in this data set, and that is, and this is where I alluded to earlier with wages and inflation. Another interesting piece of data that comes out of this data set is, and by the way, this is a survey put on by the National Federation of Independent Businesses, NFIB. They've been doing this survey. I think it goes back at least to the 1980s, if not the 1970s. And one of the components of this survey is also what's called propensity to raise wages. And what we're seeing right now is very, very low propensity to raise wages. Small and medium-sized business owners aren't feeling a lot of wage pressure. And this is, again, pretty understandable given the fact that employment writ large in the U.S., or unemployment, I should say, is still around 7%. And as we detailed in areas like hospitality, it's actually much worse. But what this means if you're a business owner is that you're probably not seeing a lot of wage inflation, and therefore that part of your expense base is probably, the inflation there is being contained, which may be a positive thing in terms of trying to control expenses in this environment. So just in summary, going back to the first part of my presentation, at Riverfront, we think 2021 is likely to be a solid year for the stock market again, due to this massive amount of fiscal and monetary stimulus. So meaning not only stimulus coming from the Federal Reserve with keeping interest rates low, but also on the fiscal side with political policymakers and stimulus packages that are likely, multiple stimulus packages that are likely to be seen in the early parts of 2021. You put that together, it's a massive amount of capital in the system. We think that will eventually continue to find its way into the stock market. We also expect consumer spending to rise in the second half of the year, particularly around, as I mentioned, the higher earning part of consumers. However, we are not predicting a major inflation spike, so we think this will give the Federal Reserve the ability to keep interest rates relatively contained. And of course, the last part of our conversation was around this concept of the dual speed economy. Half of our economy is employed and is making as much money as they did before, if not more, and has been spending less. So there's a tremendous amount of pent up demand in that part of the economy for consumer spending, including on things like wine. However, there's a whole other part of our U.S. economy that's really struggling and that continues to struggle. And again, I think as a business owner or as someone running a vineyard or operating a wine distribution network, it's important to think about your business and what parts of your business are affected by each one of those parts of the economy, because it's almost like we're in two different countries as it relates to, one part of the economy doing fantastic and the other part of the economy really, really sputtering. So hopefully I've given you some things to think about, maybe some stuff that's useful. And again, I hope you enjoyed this, and I hope you invite me back sometime when we can do this in person, and I can fly out to Oregon and enjoy all the unbelievable reds that you have out there. Obviously, I'm a big Pinot Noir drinker, so I can't wait to get back out to Oregon and see my friends out there. So anyway, thanks again for your time, and hopefully you found this useful.